title of this video is going to be Simple Weekly Option Setup. And basically what I want to cover in this video is a simple trade setup in the weekly options. So the weekly options are exactly what they imply. They are options that last for 1 week, normally around 5 days, trading days. So the indexes, I believe they start trading on Friday and they go to Thursday. The ETFs and stock options, they go from Monday and they end on Friday at the expiration on close on Friday. Now, not all stocks, ETFs have weekly options, but they are gaining in popularity. So more and more stocks are getting weekly options. You'll probably see them if you want to look for them in the option chain of your broker. Whenever you do a trade, make sure you pay attention to how many days left to expiration in the particular option that you're trading, because the months is the same. It's just there's a couple other letters, numbers in the name of it. But the way I check is I look at how many days to expiration. That's when I know I'm in the right option. So basically, the goal of this setup is to take advantage of a large move in the markets with a directional credit spread. Now, this is not the only way to trade weekly options. This is just one, and this is a very simple way. It's a setup that whenever it shows up, you can trade this particular trade. And what we're looking for is a large move in the markets. Trying to make 3 to 5% or more in a week. This really depends on the volatility in the markets at the time. 3% a week on a weekly option is not unusual, but what we're trying to do with this setup is we're trying to put the odds even more in our favor. And basically the thinking is that if the markets move early in the week, let's say on Monday, if the market is up 3%, the whole market is up 3%, the chances are pretty high that the market is not going to continue moving up 3% every day for the rest of the week. It'll probably move down the next day. It'll probably move up a little bit, down a little bit. And if you do sell options far enough out of the money, those options should expire with a relatively safe bet. So what we're trying to do is make at least 3 to 5%. You can probably make more, especially if the market moves down. Volatility will go up and these options will be worth more. But we're looking at least 3 to 5. We don't want to do any adjustments. We want to enter and exit, and that's it. And if we can just enter and let it expire, that's perfect. And we also want a high probability of profit, like we do on all of our trades. So now, let's go to the next slide. The setup itself. To get into this trade, we want a large move in the markets on a Monday or Tuesday. If we have a large market move on a Wednesday, Thursday, or Friday, it doesn't really do us much good because there won't be that much premium left. 2 to 3% move is good. The direction does not matter. It could be moving up or it could be moving down. That doesn't matter to us. We just want a big move on a Monday or a Tuesday. We're going to play any of the indexes or even the ETFs, SPX, Diamonds, MNX, which is NASDAQ, or any of the ETFs. It doesn't matter which one you trade, whatever you're comfortable with, you can trade. The market should move on little, no, or stupid news. Now, what do I mean by that? I mean that, if it's Monday and some really big bad event happens, that's big news and we would not trade. If there's no news and the market is just up for whatever reason, then that would be a good trade. If it's up on stupid news, and what do I mean by stupid news? Like on, for the Monday in 2011 after Thanksgiving, the markets were up 3%. And the reason given by all the financial websites and all the news channels and everything was that Black Friday was a super event. They sold a lot more stuff than they had ever sold before on Black Friday. Well, that's not a big news because they were open for much longer hours and the sales were supposed to be larger than ever, or larger than at least the last few years in the past. Black Friday the sales have not been so well the last few years, and the thinking is that, consumers have been cutting back since the economy has been pretty bad, and this year they just wanted to let loose and they went a little bit overboard. So to me, that is something called stupid news because, Black Friday, they sold more stuff. Big deal. That does not change the overall stock market enough to move it up 3% on the next Monday. To me, that's stupid news. I don't think that's really the real reason behind the move. I think the move is because the whole week prior, during the Thanksgiving week, the market was down, and then everybody came back. All the traders, all the hedge funds, all the mutual funds came back on Monday and said, "Hey, look, all our stocks are cheaper. Let's buy some cheap." So they bought it up, and the market was up 3%. That's what I think. So that would be what's considered stupid news. If there's a big event, we don't trade. And then the rest of the week should not have any big news coming up. So if there's a Fed announcement or something really big going on, we don't want to be trading. We don't want to get taken for a ride. Okay, setup continued. Any week with a holiday are awesome. Like if there are, a day in the week that the market is closed, that's great. That means that we're going to get extra time decay and we're going to have less risk because there is a fewer day of trading. The week of Thanksgiving is perfect. If there's a big move early in the week of Thanksgiving, you can pretty much safely put this trade on because Thanksgiving is closed. The markets are closed on Thursday, and then the markets are closed for half a day on Friday, and basically very few people show up to trade. So that's a perfect week. And then also the last one is, this is one that's important, that the market should not be in a super volatile mood, meaning it should not be moving up 3%, down 3%, up 3%, up 6%, up 10%, down 4%, and it should not be trading hard in one direction. So if the past week, the market is up 1%, 2%, up, and then the next Monday it's up again, you don't want to be trading that because you don't want to be going super against the trend. The more if it's bouncing around up and down, the better off for this trade. Okay, now this is a trade itself. So if the market moves up, you're going to look to sell a bear call credit spread. Basically what this is a call credit spread. So if the market moves up, you're going to be selling calls. If the market moves down, you're going to be looking to sell a bear put credit spread. You're going to look to sell puts. Which ones do you sell? You're going to sell let's say if the market moved up on Monday or Tuesday, we're going to be looking to sell a call that has a 10 to 15 delta. Anywhere around there. 10 is fine, 15, up to 15 is fine. You go higher than 15, you can get into trouble. But 10 to 15, that range is fine. If you want to be a little bit more conservative, you can sell less than 10, but you won't get as much premium for it. And then you want to buy the next out option to complete the spread. So basically we want to sell one option, and then we want to buy an option to make it a spread. We're going to get a credit, which means we're going to get money into our account. This is just a regular credit spread on the weekly option, and the minimum ROI is 3 to 5%, but you should be able to get more. Because what's happening is that the market is moving in one direction. So let's say the market moves up again. That's our assumption. The market moves up 3%. We're going to sell calls that are way out of the money, and then the next day or the day after, we're looking for the market to retreat because it went up so much, it's probably going to come back or stabilize. It's not going to keep charging up higher. It's going to get tired, so it's either going to stabilize for the next few days, or it's going to actually come down and then maybe bounce around a little bit. Either way, since we're way out of the money, we should be fine. But to make sure you do this trade on the day of the big move. If you do it after the day of the big move, you're not going to get as much action for it. So that's the trade itself. And that is the end of our slideshow. That's the end of our video. Again, just to sum it up, on a big day, look to sell credit spreads up or down depending on the move. Look to sell out of the money. You should have a pretty good probability of profit. We're looking for around at least 80-85% probability of profit. And let's see, I think that's all. So look for this trade to set up, and you can't do it every week, but even if you get this trade 5-6 times a year, 10 times a year, 15 times a year even, it's a good, nice little trade, puts some extra little money in your pocket, and it's a directional bet. It's a risky trade because there are no adjustments. We're just getting in and getting out, so don't do this with a lot of money. Again, you should only be trading with money you should you can afford to lose. And again, I'm not telling you to do this trade. I'm just educating you and telling you this is an option and this is a setup that you could look to trade. Do paper trading on this first, and then when you get the hang of it, when you feel that you're confident, then you can go ahead and make whatever decisions you want to make. All right. Now, actually, in the members only video, I'm going to actually be doing and showing a live trade. So the market is up 3% today. It is a Monday, and I'm going to be doing this trade. I'm actually going to look for one, analyze it, look at the strikes, look at the premium, and look at the return. And actually, I'm going to try to go ahead and get filled on one. So if you're not a member, you can go ahead and join today and take a look at that video as well and see what trade I'm putting on. All right. Have a great day. Happy trading. Talk to you soon. Thanks. Bye.